So there's a series of questions that focuses on correcting errors in different years. And you'll see that I've used Cadbury Limited as the company that made these series of errors. And you'll see a lot of these correcting error type questions in B01 material. But this one is about a capital asset. So Cadbury, they make chocolates and other confectionaries. And they're in the process of completing the 2013 financial statement. And what they found was in 2012, they bought an equipment, office furniture, for $4,800 on November 2nd, 2012. And they've estimated to have a useful life of 5 years. The company recorded $960 of amortization expense in 2012 instead of the $160, and the error was discovered in 2013. What we're asked to do is to complete this chart, and what this chart will show us is what is the impact of this error in 2 years, 2012 and 2013. So the first thing I would do is I would first of all calculate the amortization. So for 2012, the years of purchase, the amortization expense should have been $4,800 less zero residual value divided by 5 years to give us $960 per year. So clearly what Cadbury did in 2012 was recorded the entire full year's depreciation of $960. But in fact, what they should have done is they should have multiplied 2 over 12 months because this represents November and December. So we have to prorate the amortization. So having said that, the amortization expense should have been $160. Okay, so this is the actual amortization expense or depreciation expense, but they actually expense $960. So when we think about this, the expense in 2012 is overstated by the difference of $960 less $160. So that difference is $800. Now, there's no effect on revenue. That means that net income is understated, because if the expense is overstated and net income is understated by $800. Now, if net income is understated by $800, we know that shareholders' equity is going to be understated by the same amount. Now, given the fact that we need to balance this equation, if you remember that was the primary basic accounting equation, assets equals liabilities plus shareholders' equity, we know that the asset has to be understated. Now why? That makes sense because we took out too much depreciation in 2012. We should have taken $160, which meant that our asset is understated as well. So now we can maintain the same equality. So the asset's understated, the sum of liabilities and shareholders' equity is understated. Now, it says here that the error was discovered in 2013 and was corrected. So presumably in 2013, they would have recorded, so they would have adjusted the error, and they would have recorded $960 of depreciation expense. So we know that they would have fixed the error, so definitely the expense would have been no effect because they've corrected the error, and then net income is no effect. And given the fact that they've corrected the error, you'll see that now the correction of the error, it makes a difference. If they corrected the error in 2013, then what we would do is we would record a depreciation of $160. So the entry for 2013 would have been debit depreciation expense, 160, and credit accumulative depreciation, 160. So that would have been the correcting entry, because they would have taken, they should have recorded 960, but they over-recorded the depreciation in 2012. So therefore, the only amount that they could record this year is 160. So technically, the expense is understated by $800. If you think about it, right? Because they should record 960, they only recorded 160 because they had to fix the prior year. And the net income is overstated by 800. Retained earnings, because the understatement in 2012 will be offset by the overstatement in 2013, the shareholders' equity is no effect, because the year-to-date shareholders' equity or income would have already been corrected. Liabilities is no effect, because it has nothing to do with liabilities. And of course, the asset should have 14 months of amortization, which in essence there is, because they recorded the full year's amortization in 2012. They should have only recorded 2. And then they should have recorded a full year's amortization. They only recorded 2. So altogether, year to date, the total cumulative depreciation is correct, and therefore there'd be no effect on the asset as well. So it depends on how the error was corrected. If the error was corrected in 2013, they only would have recorded the net amount of the correction, which is 160 depreciation expense. If they did that, then we know that 2013 expense would have been understated and net income is overstated. And therefore, the year-to-date shareholders' equity would be no effect. Thank you.